Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
I truly don't believe it is too pretentious of me to start off the show by saying, you brilliant person there in your car or with your headphones on, listen over your iPod or whatever it is you're doing.
Yeah.
iPhone. Nobody has an iPod anymore.
If you do, call us.
Clear off track again.
Start.
It's Tangential Radio. Hello, everybody, and welcome to Tangential Radio. We go off into a variety of different directions, and they don't connect at all. No, my tangent was, it's not
You
too
blew
pretentious.
the whole intro, man. Maybe you should just hit restart. Good Lord.
I don't believe it is too pretentious of me to say that this, my friends, may be the most important 2 hours you will be spending this week, because this show is about to set you straight about your dough. Hi, I'm Don.
Oh, I'm Tom. I figured I could get that part right. Yes.
We get something right today.
Okay.
And we would like to invite you to get the big questions answered, to make your life better, to improve your situation, not just today, but particularly down the road in retirement, that kind of stuff, by getting the financial portion of your life in order, getting your financial house in order. I'm going to talk like this all day. And here's a question for you, for Tom and you guys, all of you. Here's a question. Do you believe the future is actually predictable?
Do I believe the future is predictable?
Do you believe it? And do all of you involved in eavesdropping on our conversation believe that? Do you actually believe that the future can be accurately and consistently predicted?
Two things I know, but otherwise, no, I don't.
You know two things that can be predicted?
Two things I am certain, yes.
Oh, the death and taxes thing?
That's it, yeah.
Yeah, but even those, you can't, you're going to die.
Don't know the day.
You know you're going to be
Yeah.
taxed, but you don't know in which bracket, because
That's a good point, or what might happen.
what's deductible anymore.
That's true. That's a good point. Good point.
So you don't know those things. You know that you will probably eat. Okay. You will drink liquids. You will do things.
Okay.
But
Let's leave it there.
I wasn't going to go any farther than that.
Please.
But we have a lot of things as creatures in common with, but that's not what I'm talking about. I'm talking about events in the future. Life events, financial events, and this really comes down to, Tom, to this problem that Wall Street seems to have with itself, where I guess it takes itself too seriously, as do the rest of us, and that is the fact that there is still this belief that people can pick stocks.
Despite all the evidence, despite all the studies, despite all of the numbers, big data says, no, you haven't been able to do that. And there was an interesting piece in the Journal again today talking about a study that goes back to 1962. Enough data probably to look at mutual funds.
Well, yeah. And it's really the only period over which we have truly thick, confident, robust data.
And it shows again that people that are picking stocks, they can't pick them better than just investing in markets.
And really, that's what my question is for everyone who's with us today is, do you, in your portfolio, do you have any individual stock?
Do you own Microsoft? Do you own Nordstrom? Do you own Starbucks? Do you own Costco? Do you own Weyerhaeuser? I guess we should say Amazon, because we don't like to tease Jeff Bezos anymore. Do you own any of those?
The Washington Post. Oh, wait, Jeff Bezos owns that.
Yeah. As individual stocks, not as...
I'm asking this not rhetorically.
Yeah.
Do you have individual stocks in your portfolio? And if you do, why do you? Do you have actively managed mutual funds in your portfolio? And if you do, why do you? Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now. Tom is going to go referee a soccer game.
Yeah, I am.
So
I'm really excited about it, too.
last hour of the show.
No, last half an hour. I'll be here for
that.
Yeah, okay.
Tom will be going. Oh my gosh! Wait, before we get back, we got Jim.
Yeah, we got Jim.
All right, remind me. I got a story to share with you about the all the computers that were taken down recently by the virus.
Mm-hmm.
Got a story to share. Jim, you're up next. Welcome to Talking Real Money.
Hi, Jim. How can we help you?
Hi, fellas. Good to talk with you. Enjoyed your show for a long time. Been meaning to call.
Glad you did.
We have a 13-year-old, 7th grade great-grandson. We've managed to accumulate about $40,000 for him, which currently is sitting not doing much of anything. The only stock he owns is 100 shares of Microsoft, which he's done well on so far. But anyway, with about a 5-year window before he starts college, we'd like to be getting into the market and wondered what you might suggest.
Okay, is this $4,000 all earmarked for education?
Yeah, essentially.
Okay, all right, good. Okay,
it was
because if it wasn't, I would
40,000.
40,000. I meant to say 40,000. Because I would have suggested kind of splitting it up and all. But if it's all earmarked for education, Tom, what should he do?
Even with just a 5-year window, I would still go to the Utah 529 plan and sign them up. Put the money over there. They're gonna
age-based program.
It's an age-based program. So it's probably today you're probably looking at 50% in stocks, 50% in something like that, because they don't want it to all be part of a big bad bear market starts up. They don't want it to disappear for your grandson. So you put the money in, and then they're gonna reduce the stock exposure as he gets closer to school here in 5 years.
The state program that you're referring to.
It's a state.
Plan?
It's state 529.
It's a Utah 529.
You can use the money for any school though in the country. It doesn't matter. Doesn't have to go to Utah. It's exceedingly low cost.
Time remaining to accumulate enough to.
Here's the thing. Yeah, if you're just going to go put it in stocks, I'd be a little wary because the market we could be right at the top of the market. We could have a 5-year period where stocks perform horribly, but they don't do that. They're going to. I
haven't done anything for the past 7 or 8 years.
There you go.
The,
no, exactly, as we all are. But we should always be ready for the next
Did
crash.
you learn something about trying to time a crash?
Yeah, I've learned that I can't time it.
Thank you. There we go. I just wanted to make that point for everyone else out there. But let me tell you, this plan
I was burned pretty badly in early 2000, and I guess I just haven't been able to push the button since then.
Yeah, the problem with getting that mental block is that market in 2000 in which you got burned recovered in its entirety plus some, and then you would have gotten burned again in 2008, and it recovered 9 months later. It was soaring again. The downturns are short and painful. The upswings, as you've learned, are long and persistent, and you can't play this game. But with this Utah plan, what they're going to do every year is they're going to reduce the exposure to stock over time. The expenses are, I believe on this one, 0.2%.
Ridiculously cheap.
And any growth or income generated by the investments in that portfolio will be able to be used tax-free. If you invest outside of that 529, there will be taxes along the way and when he takes it out.
Yeah, I'm somewhat familiar with it, although I've not really investigated it thoroughly. But I'll
go get it. Put the money in the age-based program. Trust in the system. It will not go to zero. No. It cannot. Could it go down? A little. Not a lot, because the program doesn't allow it to be overexposed to the stock market.
UESP.org. UESP.org.
Really excellent program. As a matter of fact, somebody called me this week wanting me to compare that to Nevada's, and I got to tell you, it still comes, Nevada's with Vanguard, but it still comes out ahead. We present this program with limited commercial interruptions, and here's one of those very limited interruptions. There is only one magazine I can find devoted to real investing. It's called Real Investing Journal. You can get it for as little as $15 a year with a charter subscription, but for a limited time, you can save another $5, taking your subscription to as little as $10 by using the discount code KVI. Just go to realinvestingjournal.com, realinvestingjournal.com, order your subscription, and save $5 with the discount code KVI at realinvestingjournal.com.
For your real life and real future, Tom and Don are talking real money.
Give us a call, 877-397-5666, 877-397-5666. Tom, how can you, in a very short period of time, do you think, make about $1 billion?
Feelings,
short period of time.
Nothing short. Oh,
not singing.
Yeah,
I hope not singing.
Well, no, somebody else in the family. How can you make $1 billion
in just weeks, maybe months?
Yeah, he hasn't done that. No. Wow. I have somebody give it to you.
I've just found it. No, I just discovered it. In fact, I think the National Health Service in England discovered it. Various hospitals.
Yeah, okay.
They discovered that they are helping somebody, probably in Russia, make up the number is up. They're guessing $1 billion
that they're going to have to pay to get everything fixed up.
Ransomware to get these computers. So this is definitely this is a money issue.
Am I wearing anything like I'm wearing? This is nice. Is this ransomware that I'm wearing?
What do you have, a CCCP shirt on or something?
No, I mean, by the way, this is always an issue for people because somebody came in the office yesterday and said, how am I going to know this is all going to be very secure?
So I missed part of that.
Well, no, they're asking about the security of their money. As you know, we use for our clients Charles Schwab as a custodian.
And they have redundancy on top of redundancy on top of redundancy on top of redundancy. I want to talk about the stupidity. And I'm sorry, if any of you got infected, you did it because it happened because you were stupid. The National Health Service in England is even admitting, oh my gosh, we were stupid.
Yep.
We've known all along that Windows XP is obsolete and isn't being patched any longer. Microsoft put out a patch last week that would have stopped this virus, and hundreds of thousands, if not millions of people either are running obsolete software or didn't patch their computers. Now, the other thing they had to do. Today, I get this email, Tom. Ready for this? It's my personal account. There it is. It says it's from Gmail Notify.
Oh, yeah.
Gmail Notify. It says.
And it said something, and you, it X'd your microphone.
Then I went.
Okay.
Am I here?
You're back. You're here. You're gone. I think they maybe they're getting ready to ransom you. See if they can keep you on the air.
Something's going on.
I know.
See, I made somebody mad. But I looked at the long headers on this email. I went in deep, and this is a kind of cool. You can do this. You can go into and something on all these computers will give you the headers, all the headers where the email came from. And apparently, I've checked this out. There's a kid, 20-something-year-old computer programmer who had his email account hacked. And these emails are all coming out of Jonathan.com's email account, and they're total scams. If you click on the button, it loads a Trojan into your system that puts the ransomware in your system, takes your computer over, and then you have to pay money to get out of it. We are our own worst enemies.
Yeah.
We got to stop it. Stop it.
We'll talk about the financial ramifications here in a minute, too.
Oh, it costs you a lot of money. Michael, you're up next. Welcome to Talking Real Money.
Hey,
I have a
Michael.
question for you.
Yeah.
I have like about $6,000. I want to invest it. Would it be better to do stock or bonds or what do you say?
What's the purpose of the money?
Just to make money on it?
Well, but I mean, is this going to be money for your retirement? Is this money to buy a house? Is this money to go to?
Help retirement.
Okay. And is it in an IRA or a 401k or this is just money you got?
Yeah.
And
Where is it now?
Yeah, good point.
It's in the bank, but it's not gaining any interest.
No, you're losing. You are losing money in the bank. That's a lock. I guarantee you lose money if you put your money in the bank. Well, then, here's what we're gonna talk about the big issue, and because it's a big issue, we're gonna do this after the bottom of the hour. The big issue really comes down, and I want you to think about this: how much risk do you want to take? Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com. We're talking about the things that are really important in life, about building a future. And there are some basic concepts that you cannot possibly ignore when it comes to investing money. We're talking to Michael right now, and before the break, Michael asked what he should do with $50,000 that's sitting in the bank and it's doing nothing. That's what bank accounts do. As a matter of fact, after inflation, most of the time, bank accounts actually, absolute safety ends up guaranteeing you a loss. So the question to you, Michael, is, are you willing to watch it fluctuate in value? And if so, how much?
About, I say at least 25% or so or more.
Okay, that's good. And
that's actually a great answer because it guides us. Now we can narrow down the historical activity of various securities and look at. And so, Tom, if you're willing to see it decline 25% in a year, how aggressive can you be?
Well, you could be 60% in stocks and 40% in bonds. But the next question is, how old are you, Michael?
55.
And how many more years are you going to work?
I don't know.
Apparently, that's a while.
You're not quitting tomorrow. Yeah. You're not quitting tomorrow.
Oh,
okay.
no.
All right.
He has time then. He has the time and he has the right attitude if he's telling himself the truth about the 25% downside tolerance.
Yeah, I mean, this is we all say 25% is easy. We're in the middle of a bull market, right? That's not going to happen. Well, it will happen. We just don't know when. So $50,000, unfortunately, you can't take that all and just put it into a retirement type account. You can't put that into an IRA or a 401k. The government will only allow you at the age of 55 to set aside $6,500 a year in an IRA or $18,000 a year in a 401k. Do you have a retirement savings plan at your place of work?
Yeah.
Okay. And are you contributing to that?
Yeah.
Okay. So
at the max?
Yeah, all the way up to the $18,000 that you can put in there?
Well, I have it's a union, so it's a little different, I think.
Yeah, okay.
Oh,
it may
okay.
be. It may be.
Do you have IRAs?
No.
Are you
No.
married?
Yes.
And you're over 50?
Yeah.
You and your wife could put $12,000 a year in a Roth IRA, more than likely.
Actually, 13,000.
6,500. Yeah, 13,000.
I mean, that would be the one. That for me would be a no-brainer because that's going to be tax-free
would-
growth from this point forward.
Here's what I would do. I would set up a Roth IRA for you and your wife with $13,000 total, $6,500 each, and then I would take the rest of the money and invest it in a similar fashion to the way you're going to invest inside the Roth at the same company, and then next year when it's time to make a Roth contribution again, just have Vanguard or whomever recharacterize another $13,000. Just move it right to the sideways into the Roth IRA and pay the taxes that might be due.
So what he's suggesting is you just go to Vanguard.com, open a Roth IRA for you and yourself, you and your wife, and then you open an IRA for you and your wife. So you basically have 4 accounts. Immediately, you could put $13,000, $6,500 into your Roth, $6,500 into her Roth. You could do the same thing with an IRA. You could put $13,000 in there as well.
Roths are better.
Yeah, Roths are better. And then, as Don said, then next year you could move money over to the Roth IRA. And if it was my money in the Roth, I would just own the one fund that we talk about from time to time. That is the Vanguard Total World Stock Index, VTWSX. One fund, it holds over 7,000 stocks, globally diversified, and the cost is, I think, 0.2122 a year. It's very,
tiny.
very, very inexpensive.
Oh, I see where you're going with this. This is actually a pretty good idea. Go to VTWSX in the Roth IRA.
Yeah, and
then keep that $37,000 that's left in
Bingo.
like an intermediate term bond fund.
Yep.
And then over the next 3 years,
Start moving it over.
$13,000 a year. Actually, it's 13, and 12.
You could use the Vanguard Total Bond. You could use the VBMFX, I think it is, Vanguard Total Bond for the other money if you had to, and then you slowly move that over to your Roth, and over time, you're still going to have a balance between stocks and bonds in that way, and the growth will be in the Roth. It's pretty efficient from a taxation standpoint.
There are arguments that can be made for switching it up either way, but the fact of the matter is it gets you invested, and it gets you out of this waiting game, and it moves you in the right direction, okay?
That sounds good.
Michael, thanks so much for calling.
Michael, I feel bad for you because his name is no longer the most popular name for newborns in America. Do you know what it is?
No, it's certainly not Donald.
Noah. I just read this today. Michael has been like the most popular for years and years, and now it's Noah.
Hey, the good news is with our president now, I really don't have to worry about my name becoming
That's a
popular.
good point.
Or maybe it's my fault. I don't know. Could be. Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
I want to finish out this thought with Michael, because if you listen to the beginning of his call, what he asked was, should I put it in stocks or should I put it in bonds, or is there some place that I should move the money today? And what he's really asking is where we started the show.
What's the best thing for the time?
What's going on right now, and how should that dictate where I put the money? And what goes on right now should have no influence on where you put the money, because nobody knows what's going to happen Monday. Well, other than, I guess, with Microsoft stock, but no one knows generally. What'd you say? It got creamed. It's getting crushed.
Well, it was down. It was down a little over a point, but it went straight down. It was like, whoa, roller coaster ride.
But the point is, you should have a balance between stocks, which are riskier, and bonds. I'll give you an example, because I just looked at this morning. If you had all of your money just in a globally diversified portfolio of stocks, so far this year you've made about 5.5%, which is fine.
That's great.
Yeah, that's great.
3 months.
But if you had it in a balanced approach, 60% of the money in a globally diversified portfolio of stocks, 40% in bonds, which should be safer because they're IOUs, you made about 3.5%. And that shows you kind of you made less money, but when things go down, you're going to go down less in the right kind of bonds. By the way, there's some pretty ugly bonds out there. You could buy high yield bonds, as they like to call them, that are
junk.
But the point is, there's nobody that, and if they do, you should terminate the conversation. Nobody in this business should tell you, here's what to do Monday. And I think we talked about a columnist around this a few months ago. Here's what you should do Monday, because here's what the future looks like. We don't know what the future looks like. You don't know.
Yeah, even better, Tom. I don't know. You don't know. You don't know over there. They don't know. See, that's the important line to add to that. They don't know. In Cramer, we shouldn't trust.
No. Mm-mm.
They don't know. The
Mark
mutual
Cuban
fund managers
doesn't know. He likes
know.
to sound like he does, too. It's very silly.
Every single solitary study ever done on the broad, actively managed investment industry, everyone ever done, shows over and over and over again that less than half outperform, more than half underperform. And when you take into account then expenses and extra fees, and one of the fees, we don't mention this fee enough. We talk about the management fee of a mutual fund, that average of about 1% per year. Well, we forget to mention, this is something you need to take into account in your studies of investments. If a mutual fund, and actively funds do this, if they trade their securities a lot.
Good point.
The fees for commission, they pay commissions just like anybody else. They can be 1% or more in addition to the management fee, and you can't look that number up. The only way you can tell what that number might be is to look at a mutual fund's turnover ratio.
This is how much they start the year with a group of stocks they own, they end the year with a different group. This is how much they sort of move the portfolio around. And everything you read there, too, is funds that move the portfolio around more underperform because you've got somebody there saying, hey, too late. And they're moving the money around on feelings. And by the way, so much of this business is based on feelings. Even the guys that hold themselves out as the really smart people, I'm always amazed when they say, this is going to happen next week. Why?
I don't feel good about it.
Right. It just and they use the same thing. So you want to eliminate that. And so Michael, or anybody listening, you should have an asset allocation, a balance between riskier things and less risky things that meets with your, and you asked a great question, how much up and down can you take? How much volatility can you handle? And how many years till you need the money? And what kind of rate of return are you trying to make on your money? Then you build the portfolio.
And this is one of the things that fascinates me. People say, I hate dealing with my investments. I don't trust my investment advisors are one of the least trustworthy people on the planet.
We're about even with members of Congress, I think.
I was going to say, just a smidge above Congress.
Very
just
close.
A little bit. And slightly lower than Donald Trump. So, wow, they don't like us.
Yeah.
The reason, though, is because you try to make it more complicated. You think you can go to someone and get the answer. Part of the reason you don't trust people is because you're asking them for something they cannot possibly provide. They can't possibly provide it, but because you ask for it, that old adage in the back of their head, well, the customer's always right. Mm-hmm. If the customer wants that, then I should answer it. Or if I don't answer it, I'm going to look stupid. it. Tom and I apparently don't mind looking stupid.
Well, I thought I looked nice today, but okay. I'll
but I mean, when people ask you the question.
Yeah, no, but we had this come up at a recent trip.
What's the market going to do?
Yeah, somebody started to ask a question, and they looked and they said, nope, Tom's got me well trained. I won't even ask that question. So, smart enough.
And I get it all the time. I was at we have a food truck event in my neighborhood, and we were at the food truck thing last night, and one of the older people who's got a lot of money, hey, so what's the market going to do next week? And I said, how long have you known me? Well, you're in the investment business. I said, that doesn't mean I know anything more about the future than you know, or your wife knows, or your kids know, or your grandkids know. And certainly those guys on Wall Street don't know, although they're willing to lie.
Yeah.
I'm not.
Regularly.
I am not willing to lie to you about the future because it cannot be predicted. And the only one of you out there listening who should,
I see him right there waving his hand,
actually believe that somebody can predict the future on Wall Street, you can't believe them unless you also visit a psychic and you believe they can predict your personal future. If you don't, then you're a hypocrite, because if the psychic can't do it, why should somebody with an MBA on Wall Street be able to do it?
And I'll take it one step further. If you agree with that statement, and it's really hard not to when you think logically, you should not own individual stocks. You should not buy actively managed portfolios. You should not follow a newsletter that says, here's what to do Monday or Tuesday or whatever day of the week. And you should not be day trading and thinking that there's some super secret system that somebody's designed that they're sharing with you for some limited amount of money that's going to make you more than the market. It does not exist.
That's why I asked the question at the beginning of the show. Do you own individual stocks? If so, why? And that is not a gotcha question that's an attempt to embarrass you. I really want everyone understanding that owning individual stocks is an effort in futility. You are saying you know the future. Hi, Don here. I was really shocked when I found out that there were no magazines totally devoted to investing, so that's why I decided to create Real Investing Journal, the only print publication all about investing. No business news, no lifestyle, and certainly no speculation. And you can get Real Investing Journal for as little as $15 a year, but for a limited time only, you can take $5 off your subscription, lowering it to as little as $10 a year. Just use the discount code KVI. Check it out. Go to realinvestingjournal.com. That's realinvestingjournal.com, and save $5 by entering the discount code KVI. That's realinvestingjournal.com.
Reality radio for a really great future. We're talking real money.
Indeed we are, and that is for one really good reason, because you've got to get money right to get to the kind of future you want to enjoy. It is absolutely critical that you have enough money to live the way you would like to live in the future, particularly in retirement, because we've talked, and we'll talk about this more in our upcoming class, this concept of human capital. While you're young and you're working, you have an asset. That's you. You're the asset. But there'll come a day when that asset won't be able to work as hard as it did and may not be able to at all.
Oh, I think we're about to find out here in about 2 hours for me, but we'll know soon. Yeah.
I can't believe you're still reffing soccer games.
High school soccer games.
You are younger than me.
Yeah.
So.
Not by much. Yeah. Anyway.
The deal is we want to help you become a better investor. We want to help you find that better future. And we will try to help you in any way we can with your retirement plan at work, 401ks, 403bs, IRAs, all that stuff. Anything, though, that has anything to do with money. And let's go talk to Cheryl. Cheryl, what's on your mind?
Hi. We just met with our financial advisor this weekend. He said that the fiduciary laws for retirement funds is changing on June 9th and that those funds need to be in a managed account. Can you explain that to me?
I would just have so much fun explaining this to you. I am guessing that right now you are dealing with an advisor who is a commissioned advisor, and that means they charge you a commission to get into products, and they take a trailer. The rule that's going to into effect, we hope in June, will require everyone to act as a fiduciary, and in doing so, a lot of firms are changing to a fee-based system.
Fee only.
Well, yeah, fee-ish.
Hopefully. Yeah, okay.
There's still going to be some insurance products, and it's only going to be fee only for retirement accounts.
Good point.
Because this law only applies to retirement account advice. It does not apply to all accounts. So my guess is you're with, I'm just going to make a couple of guesses. First one would be Merrill Lynch.
Well, major brokerage or a broker of some type.
Correct.
And so the word, yeah. So
did he tell you what the fees would be?
He did.
What are they? Just out of curiosity.
Let's see, where did I write that down? It's about 1.4%.
Okay. Yeah. So this is moving from, as Don said, a relationship where the party giving you advice is collecting a commission to one where they're charging you an annual fee to manage that money. Mm-hmm. And the reason at the base of all this is the Department of Labor decided, after prodding from Congress, that it's hard for someone to have a fiduciary relationship with their client if they're selling them a product, because there's a potential conflict of interest here.
Let me give you an example.
Yeah.
You have two identical mutual funds. They both have the same portfolios. Everything about them is the same, except portfolio A has a commission of 5%. Portfolio B has 0 commission. Under the existing rules, your stockbroker can sell you Fund A with its higher commission, even though Fund B is better for you in that it costs you less money. That rule is going to change that. Therefore, they have to get compensated, and they're going to get compensated through these higher fees. Now, at 1.4%, I am guessing you have a pretty big account with them. Am I right?
This particular account is not that big. It has maybe $50,000 in it.
Wow, that's actually 1.4
on a small
for a broker
account.
On a small account is surprisingly cheap, because I know, for example, Merrill Lynch starts at 2.25% per year. Ed Jones starts at 2.5% per year. So a 1.4 fee is low, but this is the direction that the industry is going, and I think it's actually a good thing. Now, the trick is to make sure that they actually give you the best possible advice inside that portfolio, and make sure that they do not ever put you into actively managed mutual funds. If they do, I don't believe they're taking their fiduciary responsibility very seriously. Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com. Tom, you know, the fiduciary thing is gonna get a lot of play in the press over the next 30 or 40 days.
I lose track because so it is on to take effect June 9th. Is that what she said?
Correct. Yep.
But some of the brokerages have been going back and forth about this. I think somebody decided they weren't going to offer any commission products, and now they're wavering a little bit. It might be Morgan Stanley.
Well, because it was Merrill. I think it was Merrill, and because they were going to lose a lot of brokers.
People are going to say, I can't make a living. Yeah,
I can't make a living.
Well, No.
I can't make a living unless I rip people off. So please don't make me be honest, you evil people.
Right.
But no, as a matter of fact, just for a plug, I write now for a financial column for Third Act Magazine.
You do?
Which, by the way, is one of, and I get nothing for saying that. It is a gorgeous
It's beautiful.
Magazine.
The writers are good generally. The best content is very high.
It's the best senior magazine I've seen in the country.
I'll go one step further. It's the best I've ever seen.
Yeah.
Anyway.
AARP's magazine,
not as good.
It pales in comparison.
Yeah, this is really excellent.
Great magazine.
And it's free.
I
think you get it free. Yeah.
It's free, yeah. And in their summer issue, I'm writing an article, and it's about the fiduciary rule and why it is so important for you to hire a fiduciary, and why it is, but to still be vigilant about the people with whom you're dealing, because you can have a fiduciary and they can charge you 3% per year.
Sure, yeah, they could still
and
use
they could
actively
put you
managed
into
funds.
Terrible products.
Yep, they could. It eliminates some of the conflict. I'll put it that way.
Exactly, it eliminates some of the conflict, and it's great because prior to this, about 1 million of the 1.1 million people who provide financial advice in America didn't always have to act as a fiduciary. Now, this law will not require that they always act as a fiduciary. It only requires that you act as a fiduciary when giving advice on a retirement plan.
Sadly, you could still get taken with non-retirement money.
Right. So they could still sell you variable annuities or
and they will
index annuities and that kind of stuff to make the big commission. So still be careful. But it's a great thing. I mean, it really is.
All right, should we go back to the phones?
If you want.
Okay, because Curtis has been very kind and waiting for us.
Yeah, Curtis, hey, welcome to the show.
Thank you. I've been listening this morning.
Thanks.
How can we help you?
Well, I have a question on this fiduciary hiring and stuff. So and I think you might have just answered it by saying that it's only for retirement funds. Because I have a financial advisor for two separate trust accounts that I have. And then they use Merrill Lynch to do all my trading, but these are trust accounts, and so I don't think they're
they are not bound by the new rules. No, the new rules are from the Department of Labor, and the Department of Labor's authority only extends to retirement account. Now they've stretched that to include IRAs, but no, a trust account is going to fall outside of those rules, so they can give you advice that is merely suitable, not in your best interest, but just suitable.
Okay, yeah, I've been with them for years, so my dad, who passed away, he started using them, and then I've just continued after he passed away.
We see this a lot. There's a lot of status quo. I know those people. It's been okay, and by the way, it may well have been okay, but I don't think if I was making a decision, that wouldn't be how I'd make the decision. I would only want fiduciary advice. I would want somebody using low cost index style or index mutual funds, and that has a philosophy.
Not making trades with Merrill Lynch, because that means that they're actively managing the account.
Well, Merrill Lynch does the trading for them, as far as I can.
Right, that's what I'm saying. But if they're trading in the account, then it is not a passive approach to investing. It's an active approach to investing. In other words, it's what we believe is just guessing. They claim they have skills. I disagree.
Well, they can't show us any numbers that would suggest that they did. I'll put it that way.
Okay, yeah. And I was when I first called you, I was looking up. It gives you a portfolio overview on what you are invested in for each account, and then it's got it mixed at about 71% equities and 28.5% fixed income for one account.
Here, I can tell you everything about it if you tell me what is in the equity portfolio. Just a few of the names of things that are in the equity portfolio.
A few of the holdings, stocks or mutual funds, or
okay. Hold on, just a sec here.
Yeah, because we'll be able to. I can almost see the portfolio in front of me without him saying it. But go ahead, Curtis.
Apple, General Electric, Schneider Electric, SE, ADR, a whole bunch of names.
Okay.
Coca-Cola.
I don't need any more. I'm good now. I'm good. What they're doing is buying individual stock, thinking that they are smarter than the market. And I can almost guarantee you that your portfolio long-term performs right in line with the market, less their fees.
Pretty much, yeah.
Yeah. Well, then what's the point of having them if all they do is give you what the market gives you at a far higher price? And I guarantee also that their price is higher than 0.2% per year.
Five times
far
that,
higher.
6 times. I mean, it's going to be way more. No, the point is well made. By the way, they've been right about Apple so far this year because it has beaten the market, so hooray for that. But what Don is trying to point out is in a typical what I would call broker's portfolio, you do have individual equities. You usually then have as well some mutual funds in there, generally actively managed. You might have some individual bonds and then a bond fund or two. This is what we see generally. And there is no academic work that says that will do better. In fact, it's quite the opposite than, as Don pointed out, just getting what the markets provide for a very long period of time.
As a matter of fact, Curtis, do you get the Wall Street Journal?
No, not right now. I don't.
Okay. Go get today's Wall Street Journal and read the Weekend Investor column. It tells you that what they're trying to do, and he gives you facts and figures. What they're trying to do, same thing we're telling you. What they're trying to do is literally impossible to pull off. The only a few people ever do, and those people's skill is more attributable to luck. It's just perceived skill. They just happen to be lucky.
Weekend Investor, it's Jason Zweig's column. He's the one person I do believe in this business that you get honesty from each and every week in the Wall Street Journal. And so, I think it's a great idea, Don.
Curtis, thanks so much for calling. Again, re-look at this relationship. Really give it a critical look. And we're not saying go with us. We're saying go look at it, make sure you're getting the best deal for you and your future and your family, and that you're getting truly fiduciary advice, and that you're getting it at the lowest possible cost, because that's the one thing that'll put more money in your pocket. Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
For your real life and real future, Tom and Don are talking real money.
Welcome back to Talking Real Money. Your questions, your calls about, well, something that's really important to your future, and that is money. So we try every week to give you some, solid advice that's somewhat disinterested. It's not, about us. It's about you. And we were talking to Curtis a couple of minutes ago about, his portfolio, the fact that he has individual stocks and he has these generally actively managed mutual funds. And why wouldn't you own those? Well, you wouldn't want to own those because the track record has been, as Jason Zweig points out and Don mentioned in the Weekend Investor column today, that there hasn't been anybody who can do that over a long period of time and do better than the market. So it just doesn't make sense to follow that advice.
Absolutely. And that's the whole point of what we're trying to do here every week, is to get you to think about money and to think specifically about investing totally differently than people have forever. As a matter of fact, in Jason's column, he mentioned the sales, the precursor precursor of mutual funds, which were these investment trusts.
Yep.
And they were in 1929 claiming that they could substantially beat the market.
Yep. Mm-hmm.
And a lot of these products lost everything. You see, the point we're trying to make is we want you to build a portfolio that cannot lose everything. That cannot lose everything. That's the point.
And yet people believe that about investing. That's an all or nothing game. It is not. Well, it certainly hasn't been unless
if you play it.
Well, yeah, or like you go buy individual companies, right? Mm-hmm. You buy very narrow sector of just a few firms. Maybe that sector could go away. That certainly has happened. I mean, if you were investing in buggy whips up till, the early 20th century, then you might have been out of money by a short period of time later. That could have happened. But if you buy a globally diversified portfolio, that has not happened. And stocks, even diversified, didn't reduce the volatility in 2008. They did in 2001, 2002, by the way. The basics around portfolio construction. It sounds boring, but it really we tell it in an interesting way, all right? And Don delivers that, and it's fun. And we spend some time, I do, on getting the money out of your portfolio in retirement and paying yourself without having to take it all and hand it to somebody who wants to sell you an annuity. Because this is a tragic, just met with somebody yesterday that put their entire
annuities
IRA.
Are tragic.
Yeah, the entire IRA in the annuity, and they got to wait another year to get their money back, but at least they're going to get their money back. That's good, but it doesn't make sense. So these are exactly what we try to teach you. We give you the basics, how to use index funds. And actually, we're going to, for those of you who have already taken in a class, we're going in the next step on indexing, which I think you'll enjoy. So, can I mention this?
It's a brand new class.
Yeah, it is.
I really have been slaving over this class. This is all new material. You've seen our classes before. There's some of the same stuff, but boy, it's a new twist. And we've just got somebody else signing up for Tukwila. I think we're down to 5 tickets now.
Yeah, Tukwila that's Thursday night. Tuesday night in Linwood, we still have a few seats. But Bellevue, we got the special offer. 2 for 1.
Because we have a lot of seats.
Yeah, okay. 2 for 1 next Saturday at the Hyatt House in Bellevue. Retirement investing, retirement income. Don and Tom together. 2 huge egos, 1 small stage. It's a show. I tell you what.
Again.
Yeah, it's scary. But no, it'll be fun. It's a couple of hours. It's not just about, let's look at the expense ratio, PE rate. No, we don't get into all that. It's not like that. It's really designed to help
dry.
you. Yeah, no.
It's not dry. It's not wet either. We don't have any water effects.
Try that, though.
But if it works.
Yeah.
But it is informative, and it is actually a class. That's one of the things that I don't think a lot of people get. And it's so funny, after the class, they go, wait, that wasn't a sale. That was a class. You mean I actually get to learn something? Yeah, I actually get to learn something. You're leaving now?
I am leaving now.
You're going to go to the soccer game now?
Good luck to the rest of you.
Oh, no.
Talking real money.
We present this program with limited commercial interruptions, and here's one of those very limited interruptions. There is only one magazine I can find devoted to real investing. It's called Real Investing Journal. You can get it for as little as $15 a year with a charter subscription, but for a limited time, you can save another $5 taking your subscription to as little as $10 by using the discount code KVI. Just go to realinvestingjournal.com, realinvestingjournal.com, order your subscription, and save $5 with the discount code KVI at realinvestingjournal.com. All right, so now you have me all to yourself. Just me and you, and Tom's gone. He's probably eavesdropping. You can call me, though, and if you need a little help and I can provide it, I'm thrilled to do it. I am just, this is what I've been doing since 1988, is giving people financial advice on the radio. And over that time, by the way, the phone number is 877-397-5666, 877-397-5666. And please, if you listen to the podcast or you listen to the KVI broadcast, broadcast on Sunday mornings, call on Saturday between noon and 2 in the Seattle area, or on the West Coast, and then 3 and 5 on the East Coast. 877-397-5666. And I want to share something with you, because we were talking about how investing and our beliefs have changed over the years. When we started investing in this country and really started doing it in earnest was beginning of the 20th century. Prior to that, there really wasn't much investing going on, and it was casual. You invested money in someone's company, and then they returned capital to you. There weren't big stock markets. There were little stock markets where people exchanged ownership, but it was mostly the rich. Others speculated, others gambled, but it was mainly the rich who played the stock market, and it was a different thing. It didn't become real investing until the 20th century, right before the Depression, and it took a while for people to learn how to do it. It was very hard to learn how to do it. Average people didn't understand investing, and they thought it was a zero-sum game. They were convinced that the stock market, it was a golden age, and we were in a technological revolution like we are and have been over and over again. And of course, everybody thought the market would just go straight up. And because of that belief, a lot of people borrowed a lot of money. About 40% of all of the debt in the United States in 1929 was in stock, borrowed money. People could borrow 90 cents of every dollar they put into the stock market. So now if the stock market falls 10%, all the money vanished. You've lost 100% of your money. That is a painful loss. That's the kind of thing that scares people out of the stock market and scares them out for a very long time. And that's one of the biggest reasons why the bad economy of the 1930s, the terrible stock market of the 1930s, continued for as long as it did. Then come the 50s and the 60s. Actually, the 60s were really the time when mutual funds had become of decent size and fees were at a slightly better level, and people had a little more expendable income, a little that human capital left over, and we started buying mutual funds again, buying a few stocks here and there. Investing totally changed. And again, though, we got caught up in that belief that things can't go down. And then, because it came as such a shock, the bear market of 73, 74, after all of that optimism, people stopped investing. They just stopped. I'm not going to invest. It's too scary. Things go down too much. And this cycle just continued over and over and over and over again. But if you've noticed, the longevity of these declines has short. They don't last as long because we're changing the way we think about investing. The key to being a successful investor is to understand that it is not a zero-sum game, that absolutely, without a doubt, I guarantee that the value of stocks will go down because you have human emotions involved. People get overly optimistic about prices. People then get overly pessimistic about prices. You cannot allow yourself to fall into either camp. You can't get so excited about stocks when they're rising that you go whole hog into them, and you can't get so depressed when they fall that you leave them completely. And if you can find some balance, you're going to be better off. Let's talk about that balance. Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, we're short of Tom, but you got it done, and I'm Don McDonald, and as a matter of fact, I was getting to this point that over the years that I've been doing this, and I am coming up on my 30th anniversary of doing Financial Talk Radio next year. So over the years that I've been doing this, I have changed. I have not remained static. I initially believed that smart people could make smart predictions about what would work in the future, that you could look at certain parameters and you would know, I will know that this is going to go up. Well, I learned it didn't work that way. But the prevailing wisdom of the time was that that was the way. No one ever questioned the way. There hadn't been any studies done comparing active management. There had been none that I was aware of in the late 80s or early 90s comparing the performance of active money managers with just the market. Over the years, there have been so many of them that it's undeniable. I would be a flat earther if I told you, like so many still do on the radio and on television, if I told you that I could and I believe that people could predict your financial future. It's like saying, I know, all evidence to the contrary. I'm still pretty sure because I look out my window and I don't see a curve down the street. I'm pretty sure the world's flat because that's just, my eyes don't deceive me. I can't see around it. I would be a flat earther. So I'm a smart person, relatively. And if the evidence disproves my belief, I'm either going to be stupid to maintain it or I'm going to change my belief. That's why I believe that passive portfolios, buying basically the market and then overweighting your investments into those areas of the market that have shown higher levels of return, and then creating a portfolio that is appropriate for my tolerance for risk. That's why we asked that question last hour. How much volatility can you stand? How much of a decline in a single year are you comfortable suffering through without doing anything dumb? So what you do is you find a way to reduce the portfolio's volatility, and we do that based on science. Then you find a way to increase the returns by investing in those kinds of asset classes, not picking individual stocks, but saying value stocks have shown a propensity for outperforming, and you just overweight those a little. In the process, you're building a portfolio that's really, really well diversified, so it can't ever go to zero, and that's the point. You want to make money with no chance of going to zero. I think you can do that. James, welcome to the show. What's up?
My question is, if I have a Vanguard Dividend Growth Fund, would the index fund outperform that?
You see, I can't tell you it would outperform it, but what I can tell you is it will give you performance that it's going to be different. The Vanguard Dividend Growth Fund is actively managed. It also has a much smaller portfolio than their Total World Stock Fund. The Total World Stock Index Fund is going to give you the return of the entire global stock market. The Vanguard Dividend Growth Fund is going to give you just those stocks that have paid out higher dividends, and they expect them to do so in the future. But the problem with a dividend growth fund is because the portfolio is so small, its risk is actually higher than a well-diversified portfolio that invests around the world. So my expectation, and again, this is not a prediction, but my expectation is that you would get comparable total returns at a lower level of volatility. You might even get higher total returns, again, because the Total World Index is a portfolio designed to grow, not to pay out dividends. It does pay out some dividends. But do you have the dividend growth because you want income from it, or why do you own it?
I own it just to make money.
Yeah, okay. Well, if you're owning it to make money, then I believe, based on a lot of evidence, that you're going to be better off long-term, both from a risk and a return perspective, by being in something like the Vanguard Total World Index. Also at a lower cost. And remember, this is an undisputable fact. The less you pay, the more you make.
Okay, so the dividend growth fund, it's not a loaded fund, but they still charge, I think.
Well, the internal fees, the management fees and expenses for the Vanguard Dividend Growth Fund are 0.3%. The fees and expenses for the Vanguard Total World Index are 0.2%. So they're a third lower. That's substantial. Financial.
The index fund is a third lower.
A third lower. And here's the thing that concerns me. There are a couple things that concern me about owning an actively managed fund. One, they're trying to predict the future. Even though it's Vanguard, they're one of the better companies overall, but I don't believe the future is predictable. The other thing is the volatility, what's called the standard deviation of that fund, is about 12%, and the Vanguard is about 10%. So it's not as volatile. Let's look at the portfolio again. The portfolio of the World Index Fund now is at 7,600 stocks. That's really well diversified. Whereas the Dividend Growth Fund is, got two screens going at the same time here, bouncing back and forth, 45 stocks. Diversification is your friend.
Fund, you said 45?
45. Whereas the Total World Fund has 7,600 stocks. You would own the entire world in the Total World Fund, and you would own it for less money.
So the best thing, so what I could do then is call Vanguard and have whatever money I have in the Dividend Growth Fund, have it switch over to the index or the index fund.
To the Total World Index Fund. You will reduce your risk, you will increase the diversification of your portfolio, and you will lower your costs. And I expect that over the long term, you're probably going to make as much, if not more money, but you're going to do it without being as scared. That's the point of diversification. It helps you keep from getting frightened out. Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures.